We've all been told pensions are really important, but no one has ever really explained what pensions are to us. If you don't understand how pensions work, you may well be missing out on one of the best wealth building tools the UK has ever invented. Today, I'm breaking it down into plain English so you can understand how this best saving and investing tool works. Hi, I'm Gareth Shears. I'm a chartered financial planner here in the UK, and I've been helping clients for nearly 2 decades build and protect their wealth for the future. Today, I'm going to cover off the different types of pensions, how you get free money when you pay into one, how they're taxed, how they actually grow, and how ultimately you get that money out when you come to retirement. Okay, there are 2 main types of pensions in the UK. The first one being a workplace pension, which is set up by your employer. The second one being a personal pension, well, that's set up by you and that is purely owned by you. Now, workplace pensions can be broken up into 2 types. The first one being what we call a defined benefit, DB scheme, final salary you may hear it called. Now, this is what we would call your guaranteed golden ticket in retirement. It gives you a guaranteed income, a guaranteed lump sum. It comes in a few different forms and varieties, and it's generally the ones you'll see that if you work in the civil service, police, fire, general public service, you'll get a final salary scheme. There were still quite a few around in private sector, but they're becoming few and far between now. But you may be lucky enough to still have one. But you'll probably know a family member who has a final salary pension or a defined benefit pension, as they call it. These ones generally will give you an income in retirement based on the years of service you've had and the salary that you had during that time. And the second type of workplace pension is a defined contribution, which most of us will see. The Nest, the People's Pensions, maybe your Aegon, Legal and General, Aviva pension scheme that you may have in your workplace. Because these now get contributions from you and your employer. They will then have a pot value to it, which you'll usually have in a regular annual statement. And the value of what that pot is when you come to retirement is what can be used to provide you with income. Now, these are dependent on how much you put in and the growth of that investment. Now, these investments will be invested generally in the stock market, bonds, cash or property, and it depends on how yours is set up to exactly how yours is invested. And personal pensions are the same as the second workplace ones. They're defined contributions, so they will have a defined value at the end dependent on how much you've put in and how they've grown. This is dependent when it's a personal pension on how much you've put into it, or if you're doing it from your own company, how much your own business has put into it. But generally it comes down to how the contributions you put in have grown, and that will give you what is determined at the end value. Now, workplace pensions fall under the auto-enrollment schemes these days, and this is how they work. Employers must offer a pension now and give you the opportunity to pay into it. And depending on the criteria, they will pay into that pension as well for you. Now, you're automatically enrolled, but then you have to opt out if you do not want to be part of it. But remember, if you opt out of a scheme like that, you're giving up free money from your employer. Because if the employer's paying in, that's free money. They're not going to give you that money if you don't pay into your pension. Now, if you're self-employed, you're not going to have an auto-enrollment pension, but you do need to make sure you set one up for yourself, because how else are you going to provide for your retirement? Especially if your business is a lifestyle business and you're not going to be able to sell it for a value to use in retirement. Let's talk about the free money tax advantage of a pension. This is called tax relief. So tax relief is a government top-up which is paid into your pension depending on the tax rate that you pay. So let's go through a very simple example. If you're a basic rate taxpayer and you make an £80 pension contribution, the government will increase that by £20 to £100. So the gross contribution that goes into your pension will be £100 from your contribution of 80. Now, if you're a higher rate taxpayer, you can claim the additional 20% or £20 in this instance. So what that would cost you then in real terms is to actually get £100 into your pension pot, you technically really only have to be putting £60 in because of the tax relief. The tax relief for the higher and additional rate has to be claimed by a self-assessment, okay? The additional rate is an extra 25% tax relief. Now, going back to in a workplace pension, the employer will be contributing as well, but you'll still get tax relief on your element of it. So this combination of tax relief and matching, you will not get anywhere else. So don't give up that opportunity of having the workplace pension, because it's free money plus tax relief. It's a double whammy for you. Let's explain a little bit about how these pensions grow. So if we go to the first workplace style, which is the defined benefit final salary scheme. So within this, you accrue guaranteed income for every single year that you stay within the scheme. The income element to it is index linked, so therefore it rises every single year with a set parameter of how that inflationary rate is used. Now, if you stop working for the company, your pension contribution stops there, so you stop accruing the years of benefits, but the pension underneath will keep increasing with inflation. So the income you would get in retirement will keep going with inflation. Now, the growth on a defined contribution pension, which is what most of us will be having, now that is determined around actually how much we put in, the level of growth we kind of get from that will show us then what the outcome will be at the very end. Now, these pensions are made up of underlying assets of the great companies of the world in stocks and shares, bonds, gilts, loans to the government, and other assets, which might be things like cash. There may be some gold in there and property and things like that, okay? So another important point is how pensions are actually taxed. Pension is a very tax efficient tax wrapper, just like an ISA, although it has slightly different rules. Everything within it grows tax-free right up until retirement, and then that is when you start to pay tax. So with defined contribution pension, you only pay tax when you withdraw the money, okay? The initial part will be tax-free. Current rules say that 25% of your pot will be tax-free. There may be some old quirkier pensions which have a slightly higher tax-free cash, which again is a guaranteed benefit, but I'll cover that in a different video. But anything after your tax-free cash will be taxed at your marginal rate. Be mindful, you do have a personal allowance as well. So if you haven't used your 12,570 because maybe your state pension hasn't kicked in, or you're not working, or you don't have any other benefits, that's still an element of tax-free that you could draw from your pension. But anything above that limit will be taxed just as you were earning without the national insurance. And the benefits of this tax deferral until retirement is that you've had the tax relief, and then that money is going to grow compounded over time until you get to retirement. And that is why it is such a brilliant savings vehicle for the future. And just to go back to defined benefit pensions, how they are taxed is they are taxed just the same as in income. So they will have a tax-free cash element, and any money that you take out of it will be taxed at your marginal rate. But bearing in mind, if you're not using a personal allowance, that will be used towards that allowance for that defined benefit pension. So let's cover off accessing those pensions when you get to retirement. Okay, so for the defined benefit pension, now this will pay a set income guaranteed for life, which will be index linked, so it will go up with an inflationary rate each year. But that is set from the outset. Now, there will be some other quirky benefits in there, like spouses benefits, which maybe if you pass away, 50% of that payment will go to a spouse. It'll also have potentially children benefits once children are no longer dependent or in education. Therefore, after that then, the pension premiums income will die with you. The income is taxable just like a salary, like I said before. There'll always be an option to take a tax-free lump sum. Now that will be on different levels. There'll be a lower amount or a full amount, and you get to choose the options on them. So that is relevant to how you would like to retire. Okay, defined contribution pensions, which most of us will have. How do they work? Okay, so defined contribution pensions, the current access age is 55. Now that's going to be shifting in April 2028 to 57. And that then is going to track the state pension. If your state pension is 68, it's going to be 10 years less than that. So it means your access will be 58. So be very mindful of that the access to your defined contribution pension is going to keep going up with time. You will be able to, under current rules, access 25% tax-free cash. So for argument's sake, if you had a £200,000 pension pot retirement, you could take 50,000 tax-free cash from that pension. Then the rest then, which is 75% or 150 in that case, will be taxable at your marginal rate as you draw it out. So what are the options you could do with a defined contribution pension in retirement with regards to drawing income? So you have one option of buying an annuity. Annuity is selling your investment pot to an insurance company who will give you a guaranteed income like the defined benefit pension for the rest of your life. You can build in various types of benefits into that, whether that be spouses benefits, escalations, level, guarantees. You can build different versions into it. If your health is not great when you come to retirement, you will generally get a higher annuity rate because they will assume that your money is not going to last as long. Or the other option is you go into some sort of drawdown or flexible access where you draw down money as and when you want to, and you just pay tax at your marginal rate. Now, bear in mind with the second option, the money remains invested for the future, so there is that element of risk. Your money will go up and down over the long term. With an annuity, you're selling your pension and it's gone. Okay, let's cover off some key risks and considerations when it comes to these different types of pensions. So the defined benefit pension. If you take early retirement, earlier than potentially the set retirement age of 65 in the pension, the income will reduce. They call it an actuarial reduction, so it will reduce. And that can range anywhere from 2.5% per year upwards. So if you went 10 years early, for argument's sake, at 2.5%, it would mean that your income and tax-free cash would be reduced by potentially 25%. Now, different schemes have different rates of how this is calculated, so you need to check your scheme rules for that. Remember, leaving the scheme by leaving your employer or opting out of the scheme means you will no longer accrue any more years of service. Defined contributions, some of the key risks around that is that you have a pot of money. If you draw more than is sustainable, that pot of money will run out and you won't have any more money left. The difference with a defined benefit is that is a set amount of money for the rest of your life, which will keep going up. But when you've got a defined contribution pot, that is at the mercy of the investment markets, can go up and down. And if you draw more than is sustainable, then you could run out of money. And that is why we always suggest having a financial plan and running a cash flow forecast for your future, especially with the defined contribution pension. And tax planning is really crucial when it comes to defined contribution pensions, being tax efficient and how you extract the money, especially with some of the changes coming in 2027 around pension. In over 18 years of working as a financial planner and working with clients moving towards retirement, the ones who've done well in retirement, the ones who've consistently paid into the pension from the time they started out in employment, the more you pay in, the better the outcome's going to be. And also to have a plan to understand where that's going. The earlier you start with a pension, the longer compounding can really work its magic and help you get to that magic retirement age. Now you know the basics of how pensions work, the types, the free money, the way they grow, the way they're taxed, and actually how we get that money out in retirement. If you make best use of your pensions, they will become one of the single best tools to get you into a healthy and sustainable retirement. If this has helped you understand pensions and get rid of some of the jargon you see out there, please like and subscribe because you'll help me share this to other people who need to know about it. If you need help with your pensions, look in the caption below where you can book a free consultation call with me.